Now that we've reached the second half of 2024, let's recap the first 6 months of the year and discuss what we might expect in the markets and the economy over the remaining 6 months. The stock market has had a really strong start this year, and the S&P 500 ended the first half of the year up 15.3% on a total return basis. Tech stocks played a significant role in this performance and ended the first half of the year up 28.2%. In fact, this was the fourth best start to a year for technology stocks in the last 35 years. Large cap stocks have continued to outperform small cap stocks by a wide margin. The last time we saw large cap outperform small caps by this wide of a margin was December of 1999 during the tech boom. One of the brightest spots on the market so far this year is the minimal volatility that we've seen. Here, I'm defining volatility as the number of single-day stock market returns of plus or minus 2% or more. For comparison, we saw 46 days of plus or minus 2% in 2022, 2 in 23, and only 1 so far in 2024. Now you might be thinking that's great, but what does that mean for annual returns? Well, from 2001 to today, years that saw less than 10 trading days of plus or minus 2% had an average annual return of 17.9%, compared to years with more than 10 trading days of plus or minus 2% having an average annual return of just 0.3%. But wait, this is an election year. Surely we'll see volatility pick up during the second half of the year, right? Unfortunately, I don't have a crystal ball, but what I do know is that the first half of 2024 marked the second strongest start for stocks in any presidential election year since 1928. Historically, when the S&P 500 registers a positive return over the first 6 months of an election year, the next 6 months are strong, with an average additional gain of 7%. A few things to keep in mind this election year are: 1. People care about politics and markets do not. Stocks tend to do well in presidential election years and have had a positive return in 20 of the last 24 presidential election years from 1928 to 2023, averaging a 12% return. 2. Markets have performed well under both parties. Since 1936, the 10-year annualized return of U.S. stocks made at the start of an election year was 11.2% when a Democrat won and 10.5% when a Republican won. 3. Stocks march higher over time, regardless of who's in office. In fact, a $1,000 investment in the S&P 500 back in 1933 when FDR became president would have grown to more than $19 million in 2023. During that time, there have been 7 Republicans and 8 Democratic presidents. These points can help ease concerns and reinforce the fact that while near-term events like presidential elections can bring short-term volatility, it is often short-lived. It's important to keep in mind that the economy drives monetary policy, not elections. What about inflation? Inflation has continued to decrease this year, and it is still likely that the Fed will start to cut rates this year. When thinking about the timing and the catalyst for the Fed's next rate move, it's important to remember that their 2 main goals are price stability and maximum employment. The central bank has not hesitated to make policy moves in either direction in past election years. Political agendas do not drive their decision-making. In summary, we've seen a very strong start to the year in the stock market. Economic growth has remained positive thanks to a resilient economy led by strong consumer spending and strong corporate earnings. Yes, we are in an election year. Yes, markets tend to do well in election years, but no, we should not be altering our investment strategies based on short-term political events. All of us here at Well Traveled Wealth are optimistic about the market and the economy over the remainder of the year. As always, thanks for watching, and if you have any specific questions, feel free to reach out to us.